All right, so we are recording. Welcome everybody to the Angel Investing Podcast. This is a show where we interview stock market gurus, investment experts, and we get their insights and ideas about the market. Things like major macro trends, market shifts, strategy, top stock picks. Today's guest is Jason Williams. Jason is a ex-Wall Street banker. He's, I guess you could kind of consider him a reformed, he has reformed his way into the Main Street space. So Jason has an expertise in passive income investing, private equity investing for retail, and he connects Main Street investors with private equity deals and situations. So companies that are looking to raise money, they go to Jason, and Jason connects them with Main Street investors. And that's going to basically be the big focus of today's conversation. Before we bring Jason into the conversation, though, quick disclaimer first. Nothing that we say here should be taken as personal investment advice. We trust our readers and our audience to make investment decisions that are the best for them. At Angel Publishing, it is one of our big pushes, or one of the big things that we believe in is empowering people with insights and ideas and strategies so that people can make the best investing decisions for themselves. So with that all out of the way, let's welcome Jason Williams to the podcast. Jason.
Hey, thanks, Jason.
I think it might be a good place to start if we if you give us a background about, how you initially got into the investing world. I know that you used to, work for, Wall Street, and then kind of, what brought you into the newsletter space, and why did you quit?
Sure,
take it from
great.
there.
That sounds great. First off, I would like to start by saying that is an awesome shirt you have there, and also a great name that you have. And we did not plan to have both the same name and the same shirt on today. It's just a happy coincidence. But as Jason said, I got my start in Wall Street. I worked for one of the bigger investment banks in the world, Morgan Stanley. I started off there, sort of pretty much at the bottom rung of the company, and relatively quickly worked my way up to the point where I was leading a team that was responsible for a lot of the trades of our North American sales desks. So, we were doing multi-billion-dollar trades with people like the government of Singapore. Before 8 a.m, we moved more money than most banks see in their lifetime. It was really impressive what we did, and it was just it was sort of I always like to say that it was just an introduction. It was like a master's degree or a doctorate in how to make money, because our clients were some of the richest people in the world. You're talking about Elon Musk was even a client of Morgan Stanley when I worked there. Texas oil magnates. We did business with even the Saudi princes and stuff. I mean, just about anybody. And being behind the scenes, getting to see them, run IPOs for people. We led the Facebook IPO. And I sort of saw behind the scenes of how everything worked, and really how, at those investment banks, we always made sure that our clients had a way to win. And a lot of times that was at somebody else's expense, and usually it was at retail investors' expense. And so that was sort of what led me to leave Wall Street. Morgan Stanley was great. I learned a lot. I met a lot of great people. I mean, I literally got lessons from all of the top experts in their fields when I was there. But, my background, my family is a little bit more, my mom, she was a teacher, and she retired from being a teacher to become a priest. My dad worked for a company helping design and test pharmaceuticals. My sister helps design buildings that, have better workspaces and make people's lives, more better at work, So basically everybody in my family is doing things to help other people. And here I was on Wall Street making rich people richer. And yeah, it was nice for my bank account, and my pocketbook got fatter, but I couldn't go to work every day knowing that we were making these people that didn't really need our help more money. And oftentimes, we were taking that money right away from the people who really did need our help. And so that's what led me to leave Wall Street. And I started my own family office and started, using what I learned at Morgan and, the strategies that I developed, the connections that I developed there, the network of people that I met to make my own investments and sort of help manage money for some of my friends and family. And that was what eventually led me to Angel Publishing. I met the owners of Angel Publishing, and we got to talking about why they had founded the company and sort of their goal with the company, and everything just lined up. I mean, they started this company, as you said, to help empower retail investors, and that's exactly what I left Wall Street to do. So, it was just, it was a no-brainer to combine forces.
Yeah, so, and now you're running, like, what, 4 different investment advisories?
4 currently.
You're juggling a lot. I do want to ask you more about those, but first, maybe we could give the listeners a little bit of juice, something to work with. The market's a little bit volatile right now, and I kind of want to hear from you. What are some of your top investment ideas at the moment, and then maybe some areas that you think like people should be staying away from?
Okay. Yeah, definitely. No, and you couldn't have put it better. The market is definitely a little volatile. That might be an understatement. It's been a rough couple of weeks for people recently, and more and more you're seeing headlines about everybody being more and more certain that we're headed towards a recession, stagflation, and some of these things that people were saying a couple of years ago and getting laughed at for, and they're sort of all starting to come true. And it's definitely a scary time to be an investor. But I mean, like, my number one piece of advice is always don't panic. Don't panic. That's one of the hardest things in investing, is to take emotion out of it. But emotional investors lose money, and you don't want to be an investor that loses money. That's the opposite of the point of investing.
Yeah, well, we see these cycles time and time again, and it's pretty clear when is a good time to invest, and that's when, people are absolutely terrified and selling everything.
Oh, definitely.
I do think it's difficult to convince people that,
Oh, it's hard. I mean, you could think of it as maybe being, in the military, being at war, and you're trying to stick to your guns while everybody else is running for cover.
Sure.
I mean, it seems like you might want to run for cover, but really you should stick to your guns, because you're going to be so much better off for that. But as far as, investments that I really like now, honestly, I'm in that camp of the potential for stagflation, where we have a sort of stagnant economy that's not really growing, potentially even shrinking a little bit, but definitely not growing. But we've got inflation that continues to get worse and worse. And in times like that, I love hard assets. And I'm not one to quote Jim Cramer ever, but sometimes he says you should buy companies that own stuff and make things.
Yep.
And this is one of those times, companies that own real estate, companies that that own facilities and factories, companies that have hard assets, and investing in those hard assets yourself, like commodities, oil, gas. Those aren't really the favorite ones, and probably not great long-term investments. But in the short term, those things, they're priced in dollars, and dollars are losing their value. So those things are going to go up in value just as much as the dollars lose their value. Okay. So I really like those. And honestly, all the time, like you said, I'm one of my specialties is passive income, and in income portfolio is just the best thing that anybody can have in any market. In good times, you get the capital appreciation as the stocks go up, and you get dividends paid out to you. And in bad times, you get that cash to sort of cushion any falls, and to also give you extra money to buy these like discounted stocks when you see them. You've got great companies out there. I'll throw a big name out there, Apple. Apple's just getting beat up. Amazon's gotten beat up, but those aren't companies that are really going anywhere. So these are companies that if you've got a 24-month or a 5-year time frame, the longer the better. These are companies that are going to still be around, and that are going to be worth more 5 years from now than they are today. They might not be worth more 5 weeks from now. The short term's always kind of painful when you get into volatile markets like this. But if you have a little bit of a long-term time frame, then you're going to be good. As long as you don't panic.
And what about danger areas right now?
Danger areas. I mean, obviously tech stocks have been really dangerous. I would say just about anything that's been pegged as high growth, but also has a high cash burn rate. Companies are going to have to get more efficient. They're going to have to conserve their money, to be able to maintain the kind of valuations that they've gotten over this past. And if they're not able to, and investors just aren't going to value them like that. And I would say, these companies that really they don't have positive cash flows. They exist by taking on new investments, by selling new shares, by adding to their debt. It's going to get really tough for them to add debt. Debt's going to get more expensive. It's going to get tough for them to sell new shares into a market that's valuing the company less and less. So they're going to have to make some really hard choices, and I think investors are going to be looking at that, and are going to be shying away from them and going towards companies that really spin off cash.
Okay, so you're looking for profitable companies that are paying dividends right now.
Profitable companies, dividend companies that are even if they're not showing a net profit, as long as they have profits from operations, as long as they can sustain their operations with their sales, with their revenues, then they'll be able to make it through just about any tough time. It's those companies that are really, that are pre-revenue, that, are just sort of an idea and happy thoughts at this point. A lot of companies, unfortunately, that went public over the past couple of years are like that. And so there's already been a lot of pain, but I think that there can definitely be some more pain there.
Okay. So speaking of dividend stocks, that's kind of the core focus you were telling me when we were talking earlier. For your foundational newsletter, which is the Wealth Advisory. Can you tell us a little bit more about the Wealth Advisory? What is the purpose of that newsletter? What do your subscribers get with that?
Sure, I'd love to. I'm super proud of the Wealth Advisory. The Wealth Advisory is what I would call my flagship publication. It is how I want people to be introduced to me that have never met me before, that have never seen my analysis, that have never heard my recommendations. And it's what I would sort of also call an introductory newsletter. We're not trading any options. We're not going after penny stocks. We're investing in relatively large companies that they have a good base. They're established. Preferably, they're spinning off cash in the form of dividends. We do have a few that are just capital appreciation that, we're looking for those gains from the stocks, but mostly we really stick to just generating income, because time and time again, study after study shows that the best investment strategy is to buy companies that grow their dividends and add to those positions over time. And there's sort of an old adage that you're going to do better. It's more important to have time in the market than to be timing the market.
That's fair. And so that's kind of your foundational publication, and you have three more. Do you want to tell us about them, maybe starting with, let's hit Main Street Ventures last, because I kind of want to delve into that a little bit deeper, but maybe a brief overview of the other two.
Sure. So you've got the Wealth Advisory. That's our introductory one. We're long-term investors there. But I also know that people like to get, quick gains and do some trading. And now, like I said, I'm not good at timing the market. I don't think anybody's really great at timing the market. People get lucky here and there, but really, I'm a believer that, you need to be in the market for a long period of time to make the best profits. But I know that people do want to trade the market. And having worked on Wall Street, I know that there are ways to trade the market that, you can cut out your own emotions and you can really just dig through all of the noise and filter out everything else and just get down to the data, and that's with algorithms. Using computers. You'll hear them called high-frequency trading algorithms, high-frequency traders, HFTs on Wall Street. But these are the algorithms. They're just computer programs that literally they scan headlines, they look through data, data that's all publicly reported by banks like Morgan Stanley, by brokerage firms like E-Trade and Fidelity, and they sort of scan through all of this stuff, and then they're able to act instantly. So they'll call it sort of scalping a profit, and it's like they get, maybe a 1% profit, but because they know that they're going to get that 1% profit, they can put $1 billion behind it.
Sure.
And 1% on $1 billion is real money. And so obviously we can't be putting $1 billion behind our trades, but we have the advantage of having somebody who worked behind the scenes there, and sort of learned about these algorithms, learned about the strategies that went into developing these. Because when it comes down to it, they're computer programs, so they're really only as smart as the person who developed them. So this is some traders, a trader figured all of this stuff out. People figured this out, and then we figured out how to program it into computers. And that's what a lot of these big banks like Morgan Stanley, big hedge funds like Ken Griffin's Citadel, that's how how they make their big money, and that's how they make so much money trading and not just holding stocks for the long term. So I have Alpha Profit Machine, and that's my algorithmic trading service. And I would call it swing trades. We're not trading every day, but about every week, the algorithm brings us some new trades. It focuses on small cap companies. So basically companies that make up the Russell 2000 index would be a good is a good universe for us to pick from. We have a maximum of 10 positions in the portfolio, and sometimes we have fewer than those positions filled. If the market's really, really bearish, honestly, right now is very impressive. The portfolio is full. We have 10 stocks, and they've been going up while the market's been going down. So the machine's really been doing a good job. It's been taking out emotion. It's brought some trades to me recently that I've questioned, but I've learned not to question.
Sure.
Not to question the machine, So
just to clarify, you have coordinated basically with someone who does quantitative analysis.
Yes. Coordinated with developers, with the people who develop the actual algorithms.
And you kind of maybe you give them the parameters that you want?
Exactly. We work together to develop the parameters, them from their experience in developing these systems for big banks and hedge funds, and me from my experience working at the big banks and funds.
What are some of the, most important parameters in that? I mean, obviously, really, I don't want you to reveal everything.
The biggest thing that we look for is the flow of money. Right? Is the money flowing into the stock or out of the stock?
Okay.
And, that's something that you can tell if you dig into the data, but it's a little bit tough, if you're just looking at, your brokerage window on Fidelity. You can see volume there, but you don't know, is that volume coming into the stock? Is that volume buying the stock because it's excited? Or is that volume getting out of the stock because it knows something bad's about to happen? And so really being able to tell whether the flow is going in or out, that's a huge determinant, and that's really helpful for our algorithm.
Okay. And earlier you were talking about a long-term view on stocks. So that makes me think of your Future Giants service, yes. Which, to my understanding, it's essentially you're looking for, tiny companies today that are going to, in 5 to 10 years be these, massive corporations that you think are going to kind of take over the, major industries.
No, I mean, you really nailed it with that one. I mean, it's just as if, we're sort of looking for Tesla when it trades as a penny stock. Or you hear people talk about, if you had invested in Apple when it first went public at 47 cents. Well, Apple actually went public at like $18. But, through all of its splits, you can get it down to that. But we're really looking for Apple at 47 cents.
Sure.
And there are a lot of opportunities out there for companies like that. They're small companies. They've raised money. They've grown themselves privately. They've listed themselves publicly. But because of their small size, they can't get analyst coverage. Big banks like Morgan Stanley just can't invest in them. But that gives us as retail investors that opportunity where we can invest in these companies before they can. And so then when these big banks come in to invest in the companies, we're able to basically ride the wave that they create instead of them riding the wave that we create. And so it's kind of nice. It's getting positioned before the guys that I used to work with on Wall Street. And these guys would love to get positioned in some of these companies, but there are literally rules forbidding them from doing that. Like you take Warren Buffett, I'm sure he would love to get into some of the companies we have in the Future Giants portfolio, but Berkshire Hathaway is not allowed to invest in anything that small.
Sure. It would be negligible to their top line anyway,
yep.
Right?
Yeah.
That makes sense. All right. So let's shift to I think what is probably one of the more interesting things that you're doing right now, and that is the, private equity investing for Main Street investors. You don't have to make over $200,000 a year. You don't have to have more than $1 million in net worth.
Nope.
I don't know. There was a law that passed a couple of years ago. You can give us some more detail on it, but basically that has opened these doors. And, the law itself is not brand new, but this industry is fresh.
Oh my God, it is. It's really in its nascent stages.
And most people have no clue about it. So maybe you could tell us a little bit about the Reg A deals and
Definitely. I think it's great that we're following Future Giants with this too, because Future Giants, we're looking for publicly traded companies that are about to be giants. But with Main Street Ventures, we take it a step further back, and we're actually investing in private companies before they hit the stock market. So we're looking for we want to be those people who help Jeff Bezos fund Amazon. Those people invested at a $20 million valuation. Amazon's a multi-trillion-dollar company now. Like, they made so much money, and none of them really put in much money to begin with. I think that that it's not a public round, but Jeff Bezos has sort of commented that everybody put in about like $10,000.
Yeah.
So they put in about $10,000 at a $20 million valuation, and every single one of them is a billionaire. $10,000 made them a billionaire.
Yeah, so you can make money in the stock market, but if you really want to make money in the stock market, generally speaking, for those like massive returns, you're going to want to get in before shares are trading publicly.
Like, the stock market is a great equalizer. Everybody can get the same percentage gains, but private investments have been kept off limits to retail investors for a really long time. You mentioned, not needing to make $200,000 a year. It's actually more now, $250,000 a year. Not needing to have $1 million in liquid net worth. And that's what you had to have to invest in these private companies. You literally had to already be rich in order to get rich. And these were laws that were written back when the SEC was first created. And these laws were written by John Kennedy's dad, Joe Kennedy, who was a trader who played fast and loose back in the 1920s and lost a whole bunch of money in the financial collapse. And so when FDR called him and said, hey, would you like to write the rules for investing? He was like, I would love to.
Sure.
And I'd love to make sure nobody else gets to join this club. So they've kept us out of it for nearly 100 years now. But it was actually some legislation that was sort of slipped into the Jumpstart Our Businesses and Startups Act. And it basically allows any American over the age of 18 with an internet connection to invest in startup companies. So we can invest in these private companies before they go public. We can get the opportunity to be the people that help Elon Musk fund the next Tesla, to help Jeff Bezos fund the next Amazon. And the real reason that I started this is because, yes, this industry, it's open to retail investors. You honestly do not need my help at all to invest in it. But one, companies don't call retail investors looking for funding. They call me looking for funding, though. And two, companies don't always tell you exactly what you want to hear. They tell you what you need to hear to get your money and to get you to invest. But they might hide some stuff in the details that, a normal person, somebody without a background in finance, somebody who doesn't read SEC filings on a regular basis would miss. So that was really what my impetus for starting Main Street Ventures was, that I was looking at a lot of these different deals out there, and I was really digging into them and reading them, and I would be like, wow, like, look at this. These people are going to put up 1% of the money for this company, and they're going to own 99% of the voting rights. And then these other people, these retail investors, they're going to put up 99% of the money to get this company going, and they'll own 1% of it.
Sure. Well, so you were talking about, the laws that were put in place with accreditation. Mm-hmm. And I think the initial rationale behind that was that, retail investors aren't sophisticated enough. They're not smart enough to make these decisions. So the government was going to protect them from themselves, kind of thing. And I think the value that, you're able to give your readers and your subscribers is the curation aspect. You're able to filter through the noise because, it's not that investors aren't sophisticated enough, but it's that a lot of people just don't have the time to be looking through these things.
Don't have the time. And these companies, they definitely try and hide it, as best they can. They don't want bright red flags popping up when somebody looks at it. So, you really need the time, you need the training to really spot this stuff. But you're right. They say retail investors aren't sophisticated enough, and they were going to protect us from ourselves. And God bless them for wanting to protect us from ourselves. I really appreciate that. But we don't need that. I don't need somebody to determine my risk tolerance for me, and I doubt anybody that's listening out there needs somebody to tell them what their risk tolerance is. Like they put on their seatbelt when they get into their car, or they don't, and it's their choice.
That's fair. I mean, I agree with that sentiment for sure. Roughly speaking, how many deals are you passing on a year?
So we aim to give out at least 12 investments a year. We really like to have one a month, but unfortunately the market just doesn't work like that.
Sure.
Sometimes you have a whole slew of deals come in that are all looking really good, and you'll get 3 in a month. But sometimes you'll have a couple of months where the only things that come across my desk are those deals that I just would not feel good recommending to somebody.
You're not going to force any garbage down you.
No, exactly. And that's one of the things that I've made very, very clear clear to the investors that I work with is that, we're not, I'm not just going to put a deal out there so that they can have a deal to invest in. I want them to have the best deals. That's why I started this company. Like, that's why I started this service. That's why we run Main Street Ventures, is so that we can really cut through the bad stuff and give them the best opportunities. And I think, personally, I'm a little bit biased, obviously, but I think that I've shown the value in that. Every single deal that we have invested in, that we've exited for a profit. I'd say about 50% of the deals that we're currently in right now, where the companies are still private, those companies are now raising more money at a higher valuation. So we're looking at a profit already. One of those companies, I want to say about 6 months after we invested in it, it was able to use our money to get started, to really start building out its properties. And it was able to go and raise more money at 7 times the price that what we paid to get in. So this company hasn't even gone public yet, and we've got a 600% gain.
You're already at a 7x or 6x, yeah.
It's amazing. It's amazing. And, this one, I honestly, I think this one's going to be really incredible. I think everybody's going to be super happy, but this is going to be one of those, this could be one of those storybook things where people write a check for $10,000 and get a check back for $2 million.
So we were talking earlier about the market kind of being real volatile right now. At the time of this recording, everything is looking really scary.
Yeah.
And that kind of got me thinking about, these private deals that are essentially completely isolated from all that volatility that's going up and down. And, do you want to speak to that a little bit more, like in terms of where you're allocating your assets and how does an outside market crash affect these private investments? Does it have an impact, or is that isolation, is it completely just kind of separate from the market?
Oh, definitely. So, it can sort of have an impact, not in the way that most people would think. So a market crash will definitely have an impact on the private sector, in that private companies are going to want to stay private. They don't want to go public into a bad market, when people are scared to try new things or to, bet on the new IPO.
So it might prolong your exit.
So it will definitely, it can definitely prolong exits, but it can also send some of that money that's coming out of the public markets into the private market. So it can be a really good time for companies to actually raise funding. So we may see, we may see more companies, more opportunities, more potential deals, so that these companies can raise the money, can get themselves to scale, can weather the storm, and then once everything's over, just really be off to the races. But one thing I love about them is that they're not losing value. You wake up in the morning and you see your portfolio down 10, 15% because, one of your stocks just got hit by 25%. That doesn't happen. That does not happen. None of these companies, none of our investments have moved at all. They haven't gone up, but they haven't gone down.
Yeah.
And when the markets are just plummeting, losing less is definitely winning. Losing nothing at all is amazing.
All right. So walk me through. Let's say I'm a member of Main Street Ventures. You have someone call you up for a deal, and you like it. You read through it. You love the deal. What do I see? How is that communicated to me as a member? What's the experience like for me?
Okay. So, I send out weekly updates, just on our active investments, just to let everybody know where they are. I'm constantly talking to the CEOs and the founders and everything. But when we actually have a new investment, I send out a special alert that's called a deal dispatch. And in the deal dispatch, what I do is I break down just everything that I've learned about the company, from reading through their SEC paperwork, from looking at their audited financials, from talking to earlier investors. Sometimes I'll talk to the angel investors that help the company get to the point where they're ready to raise money from us. I'll talk to the founders, talk to the executives, really look into the actual, the market that they're trying to address. And I'm going to basically explain all of that in what I feel are easy to understand terms in the deal dispatch. I try and break it down as simple as possible. I'm not going to use esoteric finance language.
Sure.
You're not going to be reading a whole bunch of acronyms and stuff like that. Just really this is why I like the company. And what I'll do is I work with what I've called a T.I.M.E.R system, where we look at the team, the idea, the market, the execution, and roadblocks. Because you need a good team, but you also have to have a good idea. You've got to have a market to sell that idea into, and it needs to be a relatively big market if you want to make billions of dollars. you've got to be able to execute. You can't just have a great idea and a big market, and then if you don't execute, you're not going to get anything. And then roadblocks. You need roadblocks. You need roadblocks to keep competition from coming in. Say you're a small company and you've figured out this great new way of doing things. What's to keep a company like Amazon, who's got tons of cash, or Facebook or Tesla or whomever, from just just replicating what you're doing?
Gotcha. So you're looking for a wide moat, basically.
Definitely a very wide moat. That's a better way to put it than roadblocks, probably. But we're also looking for potential roadblocks that the company might run into.
Sure.
And is the company looking into that? Have they done their strength, weakness, opportunity, threat analyses? Are they sort of planning for perfection, or are they planning for it to be a rocky path up there? Also, one of the most important things that I ask them is what's their exits plan. Because everybody,
you don't want to be sitting in a
exactly. Private investing is great, but you can only make a profit if you get to exit your investment, and typically that happens through an acquisition or through a public offering on the stock market. And I can tell you from watching some of our companies do IPOs that it's just so exciting watching a company being able to sell into an IPO instead of buy an IPO.
Yeah, that must be a beautiful thing. It must feel
really
great when you're doing it.
It really is.
That has me thinking, where are your shares? Where do you manage your shares? Because obviously I'm not going to go to TD Ameritrade and pick up shares of this private company. So where are these retail investors holding their shares? And then when a company does have their IPO, does that just automatically get transferred to your account? How does that all work?
Well, there are definitely some steps in there, but we try and break it down and make it as easy as possible for people, giving step-by-step instructions on how to do it. But basically, when you make these private investments, the shares are typically held by a transfer agent. So the transfer agent just has an account, kind of like a brokerage account, but slightly different because it's private stocks in there, in your name, and then they hold those. And then when the company is ready to go public, is ready to list its shares in the market, basically what you'll be able to do is take those shares from the transfer agent and deposit them into your brokerage account. And there's just, it's a relatively standard form that pretty much every brokerage is going to be like a little bit different, but basically the same.
And you'll walk everybody through it.
Yeah, and I walk everybody through it. It's really simple. You can either select to just transfer the certain assets in that account, or, if those are the only assets in that account, it's even easier because you just check the box, transfer the whole account. And, they can deposit them in there. And then as long as there's no holding period. Now, sometimes private investors will have what's known as a lockup period, where for maybe 6 months after the IPO, they're not allowed to sell their shares. Once that's over, the shares become free trading, and it's just like any stock that you had already bought.
All right, so we're going to wrap up real soon, but are there any deals that are, in the pipeline that you're really excited about, or any deals that you're kind of holding on to right now that are still open that investors can get into that you think are particularly,
Oh, definitely. We've got a couple of open deals that I'm really excited about. We're investing in a company that has one of the cleanest potash deposits in the world, and it also happens to be in Brazil.
What's potash?
I'm sorry, I should probably get into that a little bit.
Is it potash or is it potash? How do you?
I've always said potash. Yeah. It could be potash. I'm not.
I don't know.
I'm not sure.
You were actually the first person to ever bring this up to me, so
okay,
I'm going to trust.
Yeah. I've always said potash. I could be completely wrong in that. Somebody will have to let us know in the comments if I am.
Sure.
So it's part of there's three basic elements that compounds that we need for fertilizer, and you've got nitrogen, phosphate, and potassium. And potash is where potassium comes from. And so the potassium, it helps. Man, now I'm going back to my botany knowledge here. I'm pretty sure it helps in the greening and the ripening, so like flowering and stuff like that of plants. But basically, these three macronutrients, our plants can't grow without them.
Sure.
And between the U.S. and Brazil, we produce a lot of ag products, and so Brazil, the majority of its fertilizer comes from Russia, from Canada, from just all over the world. Like, most of it doesn't come from Brazil. So this company figured out found a deposit, a potash deposit, and they've been developing it, and it's in Brazil. And their cost to extract the potash is actually less than their competitors' cost to ship the potash.
And shipping costs are probably crazy right now.
Oh yeah, and that was back before shipping costs went through the roof,
Gotcha.
and gas prices were at all-time highs. So it's even higher now, and plus potash prices have gone up. Since we invested in it, potash prices have almost tripled. So this company, their plans are to list on a major exchange in 2023 or 2024. Obviously, market conditions are going to have to determine that a little bit. They're not going to launch right into a full-blown recession or crash, but they've got this great resource. They've got the cooperation of the government. They've got the friendship and the cooperation of the indigenous people that live in the area nearby their operation. They've just done everything right, and it's the perfect opportunity. So that one is one that I'm really excited about. That's an open one that we've invested in already, but I definitely have a couple of new ones that are coming down the pike that I think people are going to be really excited for, and honestly, I think are going to be really great investments.
Okay, cool. Well, let's be fair to your subscribers and keep that private.
Definitely. Some of them the subscribers don't even know about yet.
Jason, thanks for coming on today.
Of course. Thanks for having me.
So we talked about a bunch of your newsletters and stuff. I think what we'll probably do is maybe leave a link under this video or next to it. I don't know exactly where, so that
perfect.
Readers can kind of listeners can learn a little bit more about these services and see which of these are maybe right for them.
Excellent. Yeah, no, definitely. I hope everybody checks it out, and honestly, I hope I see some new names on my list because I'm in this business to help people. So the more people I can help, the better.
Awesome, man. Thanks for coming.
Excellent. Thanks a lot for having me, Jay.
All right.